This is a case study about a married couple living in New Jersey. Both are 36 years old and planning on having kids soon. The wife works for Amazon and makes pretty good money with $500,000 of total compensation. They have $1.8 million of savings, and they wanted to do a review of their full financial picture. They've always rented, and they're looking into buying their first home. The wife has income that is made up of Amazon restricted stock units, and because they have never sold it, it's grown to be over 40% of their assets. They also receive a good sum of money when they got married as a wedding gift and also early inheritance, and they've always left this uninvested. The husband handles the investment side of their financial picture, but this money coming from his in-laws, I think gave him a little bit more anxiety around investing it, given also it was intended to help them buy their first home. And the wife, working at Amazon, sees her colleagues who are older burning out. So she wants to know if she can be work optional at age 50 or age 55. The questions I didn't hear is, do they have enough life and disability insurance? Should they create an estate plan? Are they taking advantage of all the tax savings available to them? And how much should they save for college? This video is for educational purposes only. It is based on a real life client of mine. It doesn't mean it applies to you. And when I do talk about products that I recommended to them, it doesn't mean it's the right fit for you. Please do your own due diligence and work with your own certified financial planner when making investment decisions. So we started by looking at where they are today. The wife makes $220,000 of cash-based compensation at Amazon and anywhere between $200,000 to $300,000 of restricted stock unit whenever it vests. Their lifestyle cost matters a lot, so we confirm the values using Monarch Money. It's about $140,000 a year. The only savings that they're doing in a retirement account is the traditional 401k plan at Amazon. They've heard about the Backdoor Roth IRA. They don't know what it is and how to execute it. But another savings is actually the fact that the wife is receiving stock-based compensation and not selling it. So at 36, this is their net worth. The wife has a traditional 401k with $200,000 in it, a Roth IRA with about $28,000 in it, Amazon stocks accumulated to be $701,000, and taxable account. The two of them combined have a little over $500,000. The husband has a traditional IRA that he rolled over from an old 401k plan, about $197,000. So their overall liquid net worth is $1.8 million, which is a very fortunate position to be in. Amazon makes up a very big chunk, $701,000. The husband has chosen to invest primarily in United States stock funds through Vanguard. And for the past 10 years, that was the right choice to make. It has grown to $906,000, making up close to half of their net worth. They have a smidget of international stocks, not enough in my opinion. They have some bond funds, which I was a little curious about, and they just thought they needed to be more conservative at some point. And finally, the $182,000, that is the cash that's been sitting idle, uninvested, because that was money intended for the home purchase that was received as early inheritance. It is a very nice position to be in, but we have room for improvement. I want to put life insurance first and talk you through them, because this was a gap in their financial plan that they didn't think about that turned out to be a big risk factor. Amazon provides their employee a base level of life insurance of 2 times their salary or up to $300,000. This is without you needing to do health qualifications. Given her salary is $220,000, she has reached the cap and has $300,000 of life insurance. This is not enough to replace 1 year's worth of income, so they definitely need more. At Amazon, you can get up to 11 times your salary, up to $2.2 million, whichever is lower. But one problem that I see is that it locks you into employment if your health deteriorates. If the wife working at Amazon goes through the health screen, turns out healthy, and she is able to get and buy $2 million of life insurance, she has coverage today. But if in a decade she wants to change jobs at her new employment, she wants to get the same level of life insurance, she will likely have to go through health screening again. And at that time, if her health, physical or mental, has worsened, it may affect her ability to qualify for the same level of life insurance. So that's why I recommend getting private term life insurance outside of your employer and lock into coverage when you're healthy. Because at that point, for the next 30 years, you don't have to do a health screen again, and you get to keep your coverage no matter what you do with your employment choices. A stay-at-home spouse contributes a lot to the household, and it is very expensive to replicate. And imagine the wife having a very high-stress job where she travels a lot, going through grief and losing spousal support. This would definitely put her at risk of not being able to sustain her high-paced work output. So I also recommended a healthy amount of life insurance for the husband because his passing would put the wife's income at risk. We got quotes for $2 million, and it chose 30 years because they are planning on having 2 kids, and we want to make sure that there's life insurance coverage until the children are done with college. The premiums for the wife came back anywhere between $1,500 to $2,300 a year, and it would benefit the husband if she passes away. She started applying. Her health screen came back much better than expected, and the premiums were actually lower, $1,165 a year, and she ended up buying it. The husband's case was a little different. For the same level of insurance, they are the same age. Because he does have a pre-existing health condition, his premiums are higher, double that of the wife's. During the application process, the insurance companies were asking for medical records that he didn't feel comfortable sharing, so he ended up choosing not to get life insurance. And that's the reality of financial planning. Even though the plan didn't turn out the way we wanted it to, the wife got $2 million of life insurance for the next 30 years that she wouldn't have had otherwise. So now let's talk about disability insurance for the wife. Amazon only covers 60% of the cash-based compensation. Her total compensation goes from over $500,000 down to $132,000 a year, tax-free. Unfortunately for them, it does turn out to be enough. If you're used to spending $140,000, it's very easy to go down to $132,000 a year. So this level of coverage at least prevents financial catastrophe. One of the main questions that they had is, should we and how should we buy a home? Currently, their rent in New Jersey is $2,850 a month. And once they have kids and need a bigger home, they can even go up to $3,500 per month and easily accommodate that in their budget. A good thing for them is they're also willing to continue renting to wait for the right home. This is important because a home purchase, especially today, is very expensive and you do not want to rush into this. A top priority for the wife is convenience. She needs a place that makes it easy for her to get to the Amazon physical office. She already knows living very close to the Amazon office is out of their budget, but as long as she has good public transportation, she was willing to live a little further away. They have a good group of friends that they want to stay near as well. We ran and modeled buying a $950,000 home. Their rent is $34,200 a year. Now, if they bought a home at the beginning of 2027, now their housing cost goes up significantly, more than double to $79,000 a year. And that's not even including the cost of maintenance for a home. So once they saw this, they realized renting isn't that bad. So I suggested to them they can still purchase a home if it's meaningful for them, but treat it as a lifestyle choice and not a financial one, because the math just doesn't make sense for you to buy a home when you can rent for something cheaper. Even though renting means you don't experience the home appreciation, you can make up for that because instead of the down payment being put into a home, it can be left in the stock market to be invested, and that may make up for the lack of home price appreciation. So now that they're not in a rush to buy a home, what do they do with the early inheritance, the money that they set aside for the down payment? I suggested if they wanted to keep it very safe, they could invest it in Vanguard's 0 to 3 month Treasury bill ETF. I treat this almost like a money market fund. It's not risk-free, but it is very low risk. It pays a 3.6% yield as of end of April. And the nice thing for them is that Treasury interest income is not taxable on the state level. So the yield alone is higher than their high yield savings account, and they don't have to pay state income tax as well. The thought of investing it into the stock market also came to mind, but I shared with them that 5 years is too short of a time frame in the stock market to have any certainty that your money will grow. If we look at rolling return periods from the last 40 years, every day's return, it's a coin flip whether you will make money or not. 53% positive, and the opposite, 47%, you lost money. Now let's skip ahead and look at 5 years, which is their time frame of decision making. There's an 80% chance of positive return, but 11% of those years, they ended up with losses of greater than 10%. Maybe there's a little bit of room for risk taking, but I suggested no more than 20%. And if they did want to invest in the stock market, they are DIY investors and value simplicity. So I recommended Vanguard Total World Stock. It's a very low cost, low expense ratio fund, and it invests in every single stock in the globe. The wife's employment, which makes her $500,000 a year, and stock ownership in Amazon doubles up the risk. So I ran a scenario first to see what if the $701,000 in Amazon stock that they had today just poof, went away, got to zero. It would take them down to 96% probability of success, assuming that she works until age 55. This is very good, but this is not all too surprising because they live below their means. There's still 2 more decades of working and making money, and they already have $1.1 million of non-Amazon investments. This high probability of success doesn't mean that they should keep Amazon stock, but it does suggest that they can afford to take the risk of holding Amazon stock if they wanted to sell stocks over time to maybe spread out and lower their tax liability. So a couple of tax advantage diversification strategies that we explored were protected puts and exchange funds. But protected puts is a very expensive strategy. When I ran this analysis on September 18th, 2025, the Amazon stock price was $226. If you bought a put option, which says if Amazon stock goes below $220, we're going to make you whole up to $220, but only for a year. But in order to give you this level of insurance, here's the premium we got to charge, the put option of $24 to protect you per share. And that cost of insurance for 1 year is 10.7% of the stock's value. And if they wanted to protect a little over half of their Amazon stock position of $380,000, that means they would have to pay upfront $40,000 for that 1 year protection. So that's a very expensive strategy to do every single year, and it doesn't really make sense. Exchange funds has been growing in popularity, I think because cash offers a very competitive and compelling option. For this client, it's not a good fit because they got to lock your money up for 7 years. And because for the next 5 years, there's likely going to be a lot of changes with this family, with kids coming in and buying a home, having their money locked up for 7 years is not a good thing to do. One common issue that you see with exchange funds is that they're taking in shares of stocks from different investors and pulling them together enough to make a diversified fund. People are trying to diversify and get rid of the stocks that they don't want to hold anymore. And there's maybe a reason for that. And what we see in these exchange funds is that even though you can diversify your single stock risk, in this case, Amazon, because there are also other people in the tech sector who are worried about their stock doing really well and they want to cash out a bit, but don't want to pay the taxes. An exchange fund like this is likely going to be more concentrated in the tech sector. Let's explore the most straightforward option of just selling it. You don't get taxed when you get stocks granted to you. You pay taxes when it is vested. So it's the exact same thing as receiving cash-based compensation and then choosing to buy Amazon stock with it. So I asked them, would you take $300,000 of cash compensation and put 100% of that money towards Amazon stock? And the answer is no. We already know from their history that they're probably going to buy a Vanguard total US stock market fund. So one thing that we did is to set up automatic selling of the RSUs when they freshly vest. It at least stops the accumulation of Amazon stocks. But she still has $701,000 of Amazon stocks, and that makes up 40% of their investable assets. My goal is to make sure that not one single position makes up more than 10% of your investments. What you're seeing here is a spreadsheet that contains every single Amazon stock that the client owned at the time. The price is based on July 17th of 2025. So the goal is to sell the most amount of Amazon stock while minimizing the tax bill. You would sort it from the least amount of growth to the highest and just start selling in order from the lowest growth. If the client sold the first half, this is what it would look like. So selling in 2025, they're at the maximum long-term capital gains tax rate. Their New Jersey tax rate is also quite high, close to 9%. They make over $200,000 as a married couple. So there's also 3.8% in net investment income tax. And this should be all of the taxes associated with selling the Amazon stock. They would get back $379,000, $63,000 of which is capital gains. And applying this tax rate that we see here, it means there is a tax of close to $21,000. And that means they get back, after tax, $358,000. So after applying the tax, they end up losing about 5.5% of the stock value. And the second half, because they have more growth associated with those shares, if they were to sell the rest of those and apply the same tax rate, they would get $331,000, half of which is capital gains, and there would be $52,000 of tax. So you're selling similar amounts of stock, but your tax bill comes out dramatically different. So if they're smart about selling a half of their Amazon stock, they may only have about $21,000 of marginal taxes that they have to pay. And it is still quite a bit of money, but it would take their exposure from $701,000 down to $331,000. Instead of having 42% of their money stuck in Amazon, now they have 20%. They're halfway through to the goal of having less than 10% of their stock in Amazon. But I felt that this was a good enough point because they have 2 more decades of work ahead of them. The percentage of stock in Amazon will continue to go down as more and more is added to other investments. They ended up selling that half on August 4th of 2025, and I was curious to see what has happened since. The money that they sold, they invested it into VT, which is the Vanguard Total World Stock Index ETF that I recommended. And as of the end of market close on April 30th, it was very intriguing for me to see that Amazon still would have done better, grown 25% as opposed to 17%, but it did so with a lot more ups and downs. The cost of $21,000 of taxes unlocked their wealth and protected against single stock risk. And I think it's a worthwhile trade-off. Let's talk about the rest of their investment portfolio. So this is their whole balance sheet. The wife's Roth IRA, $28,000 is invested in the Vanguard Total US Stock Market Fund, VTSAX. And I think this is a very good starting point, but being global just allows you to be even more diversified. So I recommended them to sell VTSAX and to buy VT, the Vanguard Total World Stock Fund. It's a one fund solution. And if you make sure that dividend reinvestment is turned on, it's a set it and forget it approach to investing. And because all this happened in a Roth IRA, it's not a taxable event. The wife had 3 mutual funds in a taxable account, and she owned Vanguard US Total Stock Market Fund and also the Vanguard S&P 500 Index Fund. Both have performed very similarly, and they've held it long enough that they've more than doubled their money. So the recommendation is still to hold. Because in my opinion here, it doesn't make sense to sell this fund just to put it into a Vanguard Total World Fund because the taxes wouldn't be worth it. Now, they did have a Vanguard Lifestyle Income Fund, VASIX, and this fund hasn't grown that much because most of the income is from interest income. So there's not much price appreciation that would come from that. So the value is $33,500. Cost basis is $32,200. Selling this would not create a significant taxable event, and it would free up cash to invest into VXUS ETF, which is the Vanguard International Stock Market Index Fund, to get a little bit more of that international exposure that they're lacking in. The husband's Roth IRA and traditional IRA is invested in the Vanguard US Total Stock Market Fund. Very straightforward recommendation to put that into VT ETF. The taxable account is similar. VFIAX, which is the S&P 500 fund, has more than doubled. The recommendation is to hold. The husband has a smaller account, about $20,000 that he invests in individual stocks in, and has actually more than doubled. So I shared this was a personal preference of what you wanted to do with it. It's not a large enough amount of money where I'm concerned about you keeping or selling them. And this was a bit of his play account. Similar to Coinbase, some have done quite well. So I left it for personal preference as well on what to do with it. Let's look at college planning for high-income New Jersey residents. Some of the drawbacks with the New Jersey 529 plan for this particular client is that their income is too high. Most of the benefit they are not entitled to, like the $750 one-time matching grant and the $10,000 per year state income tax deduction, is not available for them because they make too much money. And for the target date funds, they have chosen to use higher cost funds, which I'm not too big of a fan of. I'm a fan of index funds, and I can pick and choose and build a pretty good portfolio for the client, but the index fund options are not cohesive and comprehensive. It is missing United States small cap stocks. It is missing emerging market stock funds. And the funds that they did have are following different indexes. So it was like trying to put the card together using parts from different brands. But there is one benefit that my clients can likely benefit from using the New Jersey 529 plan. The scholarship is only for people who use the New Jersey plan and attend in-state college. And from my review, it doesn't seem to be subject to income or asset limits. So how this works is if my client had the foresight to open a 529 account with the New Jersey plan, put $3,600 into it and held on to that account for 12 years, when their kid attends an in-state college, they could get $6,000 in scholarship. So that's a pretty good benefit. So my overall recommendation to them is contribute $3,600 per child upon birth to the New Jersey 529 plan to get that in-state scholarship. And to make sure there's enough money in the 529 to fund future expenses, I recommend it for a child born in 2026 for them to put $6,200 per year. And for the child born in 2028, for them to put $7,000 per year until the kid goes to college. I recommended them to use Utah's My 529 plan. It's what I use personally, and it's what I use for my clients because they have very good customer support and they have very good low-cost investment options that work well together. And for people who are DIYers and appreciate a set it and forget it approach, I recommended the Utah's 529 plan's target enrollment day portfolios because it automatically reduces risk as your kid gets closer and closer to college age. Running the projections again, child one born in 2026, we use Rutgers for in-state tuition as a proxy, projecting out the inflation rate of education, what it has been. College expenses may end up being close to $400,000 per child, and making a modest contribution of $6,000 to $7,000 a year per child puts you in a pretty good position to be paying most of it. So being a high-income household and living in a high-income state, they really need to maximize all of their tax advantage savings accounts. So the overall theme of this section is taking advantage of all the backdoor loopholes. So the first one is the Mega Backdoor Roth 401k. So for 2025, the wife is contributing $23,500 to maximize her contribution to the traditional 401k. What she didn't know was that Amazon offers an after-tax 401k contribution that can be converted to Roth 401ks tax-free. And this unlocks a maximum contribution limit of $70,000 as opposed to $23,500. And the Mega Backdoor Roth 401k is also phenomenal for people who are planning an early retirement because the original contributions to the Backdoor Roth 401k, you can take it all out when you quit your job without early withdrawal penalties. And it's especially fitting for the wife here because she's worried about burnout when she gets into her 40s and 50s. Now, keep in mind the growth part that you experience is not eligible for penalty-free withdrawals. But one of the pitfalls with the Mega Backdoor Roth 401k, and it is for this case for the Amazon plan, is that the total contribution limit of $70,000 for 2025, $72,000 for 2026, it's accounting for all employee and employer contribution. In this case, Amazon matches 2% of her contribution, which is $4,400 per year. If my client has already contributed $70,000 already, she's already reached the cap with her own contribution rate, and that leaves no more room to receive the employer contribution, and that means she would have to forfeit the $4,400 per year of company match. So we have to be really careful about setting up the right contributions rates so you don't miss out on the free money of the 401k match. So here's an example of how this may work for my client in 2026. Assuming $220,000 a year cash salary again, let's factor in what is the limit. It's $72,000 for a 37-year-old, and accounting for the match that she would get of $4,400, and also her traditional 401k contribution is higher at $24,500 now, so it's 11.1% of her salary. So that means if we take the $72,000 limit, subtract the match to make sure we leave room to receive that, subtract the traditional 401k contribution of $24,500, that means there's $43,100 or 19.5% of her salary should go into the Backdoor Roth 401k plan. This is an incredible retirement tool because it allows your money to grow tax-free forever, and the $43,100 contribution, you can pull it out at any time after you quit your company. The second option that they haven't taken advantage of is the Backdoor Roth IRA. My client makes too much money. If they put money into a traditional IRA account, they cannot deduct that from their income. So they don't get a tax benefit today. They cannot put a single cent into the Roth IRA. But what they can do is step one, put $7,500 into the traditional IRA. Don't get a tax deduction. And then step two, make a Roth conversion because you never got a tax deduction on the $7,500 you put in. When it gets converted to the Roth IRA, you don't need to pay taxes on that. So this is a two-step Roth IRA, and it allows a high-income earner to put $7,000 per year per person into a tax-free growth account. If you're eligible for it and you have the savings capacity for it and you don't need the money for a while, I think it makes absolute sense for people to take advantage of this because the alternative is for the $7,500 per year of contribution going into a regular taxable account, and any dividends, interest income, and capital gains is subject to taxes each year. And that just slows down your growth. Now, a very common pitfall where people mess up doing backdoor Roth IRAs is not accounting for something called the pro rata rule. If you have any money in a traditional IRA account, when you do a backdoor Roth IRA, you're going to have unexpected taxes. So you must make sure if you're going to do a backdoor Roth IRA, there is no money in a traditional IRA by the end of the year. And if you do it correctly, you need to report it on the Form 8606 when you file your taxes. So let's go through an example of a bad backdoor Roth IRA. If someone has $100,000 in a traditional IRA account and they contribute $7,500 to a non-deductible IRA and then convert it to a Roth IRA, which is the two steps of the backdoor Roth IRA, the IRS is going to count a portion of this $100,000 as part of the conversion. How the math works out is $7,500 divided by the total balance in an IRA account. This is the normal traditional IRA. This is the non-deductible traditional IRA. And that means 6.98% is tax-free, or the inverse, 9.02% is taxable. So $7,500, 93% of the conversion is taxable. So you actually need to report $6,977 onto your tax return the following year. And assuming a straightforward 30% tax rate, that's an additional $2,000 of taxes that you were not expecting. Let's walk through the same example, but how to actually do it correctly. The wife had a traditional IRA with some money in it. What we did was we worked with the Amazon 401k plan and worked with them to move the IRA money back into the 401k plan. And that is okay. It's commonly known as the reverse rollover because typically a rollover is out of a 401k into an IRA account. So we do the opposite of that. And as long as we complete this before the year end and there is $0 in a traditional IRA, then you don't trigger the pro rata rule. For IRS purposes, they only care about money in a traditional IRA and they don't care that it's in a 401k. So now the wife, because we did do a reverse rollover, is eligible for Backdoor Roth IRA contributions. The husband is not eligible for the full tax-free Backdoor Roth IRA because he has no active 401k plan that he can roll his traditional IRA account into. But it does become an option if he becomes self-employed and opens a solo 401k plan or gains employment with a 401k plan. Today we went through a lot of information. I hope you learned something from it. Thanks for watching.